Today, the U.S. Federal Reserve made a highly anticipated interest rate decision, cutting rates slightly in what it described as a risk management cut. While on the surface this may appear routine, the broader market reaction revealed a complex mix of confusion, speculation, and strategic messaging that highlights the Fed's ongoing balancing act between economic growth, inflation control, and financial market stability. Interest rates, which are the cost of borrowing money, play a central role in the U.S. economy. When the Fed lowers rates, it encourages spending and investment by making loans cheaper. Conversely, rate hikes are intended to cool an overheating economy and curb inflation, but the timing, magnitude, and communication of these decisions can have immediate ripple effects across global markets. Today's cut is particularly notable because it occurred when equity markets, cryptocurrencies, and gold prices were near all-time highs. Historically, similar Fed actions have had profound market impacts. Comparable rare moves were only observed in November 2024 and January 1996, making today an event that analysts and traders alike will study closely. But beyond the headline rate cut, the subtlety of the Fed's communication, from Powell's choice of words to the release of the dot plot, played a pivotal role in shaping market sentiment. This video breaks down the Fed's decision in 5 key areas: the historic rate cut, conflicting signals from policy guidance, immediate market reactions, Fed unity and authority, and the continued focus on inflation. The Fed's rate cut today was widely expected, yet it still caught many observers off guard in terms of timing and tone. The Federal Open Market Committee, FOMC, lowered its benchmark federal funds rate, signaling a mild but deliberate easing in monetary policy. From a historical perspective, such rate cuts are rare outside of severe recessions or unexpected economic shocks. Prior instances, like those in November 2024 and January 1996, were similarly context-specific. These cuts were typically executed when the Fed perceived risks to economic growth but wanted to avoid causing unnecessary market panic. What makes today unusual is the current economic backdrop. The S&P 500 and other indices are trading near record highs, unemployment remains low, and GDP growth is modest but positive. In such conditions, a rate cut is a signal not just about the present economy, but about the Fed's forward-looking concerns. In particular, the need to manage financial risks without stoking inflation or overinflating asset bubbles. Markets often respond instantly to Fed moves, but this cut came alongside carefully worded guidance intended to temper overreaction. Traders, analysts, and economists are now dissecting the nuances, trying to understand whether this is the start of a broader easing cycle or merely a tactical adjustment in a volatile environment. The Fed did not act in isolation. It coupled the rate cut with additional forward guidance, creating conflicting signals for investors. On one hand, the dot plot, which summarizes individual FOMC members' expectations for future rates, suggests there could be 2 additional cuts before year-end. On the other hand, Chair Jerome Powell emphasized that today's move is a risk management cut, a term designed to indicate caution rather than a full-scale easing cycle. The market response to this type of mixed messaging is often one of confusion, as traders attempt to reconcile quantitative projections with qualitative statements. Historically, Powell's wording, his phrasing, tone, and emphasis has sometimes moved markets more than the dot plot itself, demonstrating the power of perception and trust in Fed communications. Investors are left asking, is this the beginning of a multi-step easing strategy designed to support growth, or simply a one-off tactical move to manage short-term market volatility? The answer matters because financial institutions, corporations, and even international actors make investment, lending, and policy decisions based on expectations of future Fed moves. The Fed's messaging underscores the difficulty of monetary policy in today's environment, supporting growth while maintaining credibility on inflation. Today, the market is testing how well Powell and the FOMC can balance risk perception with reality, and whether subtle cues like risk management will be sufficient to guide expectations without creating instability. Unsurprisingly, the market reacted immediately to the Fed's announcement, with a classic rumor realized, good news priced in pattern. Stocks, gold, and cryptocurrencies initially spiked, reflecting optimism that cheaper borrowing costs could fuel investment and consumption. Simultaneously, the US dollar weakened as traders anticipated more liquidity entering the system. However, as the market digested the nuance of Powell's words, particularly the risk management cut phrasing, prices pulled back, highlighting the complexity of interpreting Fed signals in real time. This pattern is typical when initial reactions overshoot, and a more measured trend emerges over 24 hours. Traders and investors are now analyzing sector-specific impacts. Financials may see margin pressure due to lower interest rates. Tech stocks could benefit from lower discount rates on future earnings. Commodities like gold and oil respond to changing expectations about liquidity and inflation. This volatility demonstrates that today's cut was not just a simple policy decision, it is also a stress test of market psychology and the Fed's to manage expectations across multiple asset classes simultaneously. One of the most notable aspects of today's FOMC meeting was near unanimity, only one dissenting vote among committee members. This reflects a disciplined internal consensus, which is essential for maintaining credibility with markets. Powell's control over Fed messaging remains strong, as evidenced by the careful language in press releases and public statements. By framing the cut as risk management, the Fed signals that it is responsive but not panicked, a critical distinction for global investors. Maintaining authority and unity is particularly important given the Fed's central role in global finance, where U.S. interest rates influence capital flows, foreign exchange, and emerging market stability. A perception of disunity could trigger unintended market turbulence, undermining the Fed's broader objectives. Today's meeting demonstrates the importance of central bank credibility. Disciplined messaging, combined with a cohesive internal stance, allows the Fed to navigate market expectations, economic risks, and political pressures effectively. Despite the cut, the Fed remains highly attentive to inflation risks, particularly secondary effects from tariffs and supply chain disruptions. Powell's framing of a risk management cut reflects cautious easing rather than an indication of a full-blown rate cut cycle. The Fed's balancing act is delicate. Lowering rates could stimulate economic activity but potentially reignite inflation pressures, particularly if consumer spending increases faster than supply. This is why the FOMC emphasizes data-driven policy, signaling that further cuts depend on ongoing assessment of both growth and inflation metrics. Moreover, the Fed aims to manage market expectations, preventing speculative excesses while ensuring that businesses and consumers can plan ahead. Inflation remains a central concern, as uncontrolled price rises could undermine purchasing power, erode savings, and destabilize long-term economic growth. In short, today's rate cut illustrates a careful, calibrated approach. Provide liquidity and confidence without undermining the broader goal of price stability. Markets are watching closely to see whether this strategy successfully balances short-term optimism with long-term risk management.